Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Thursday, February 19, 2015. You're looking at a daily chart of the SPY, and we're going to talk about this first, and then we're going to get into oil, and we're going to show you the whole trade setup and how $2,000 a contract and the price of crude oil was made basically in one day or even less. So let's go back to the S&P, and here's what we have. So there's some interesting stuff going on. I'm going to go to the intraday real quick. And if you go back to video from the last several days, I'm sure I mentioned this number, that the S&P or the E-mini contract, the ES contract, should this week have went down to, and it was really Wednesday plus or minus 1 day. So now that today's over, it didn't happen, but it should have went down to the number of 2070, okay? But in order to get to 2070, it had to close hourly at minimum below 2084, 2085. So I mentioned that a couple of times. And today, in the morning, we got down to 2087.50, I believe, on the S&P E-mini, and the market bounced up. And here we are. The coinciding price in the SPY contract was 209.24, okay? And in the first candle of the day, we basically bounced up and rallied up, sold off a little bit, and went flat for the rest of the day. And the market is just too quiet. And a quiet market will stay quiet for as long as it feels like it, but it won't stay quiet for long. And when it decides to not be quiet any longer, it's going to have to pick a direction. So here's what we have, okay? We're going sideways. Normally, when we go sideways, the next move is higher. However, at highs in charts, and the reason why we see rounded tops, okay, rounded tops rather than V tops like we see V bottoms in here, okay, this is a V bottom, okay, but we see rounded tops, okay, we're seeing maybe a rounded top, and if it's a rounded top, it's because the market didn't have, remember from the other day, the market didn't have the nuts to go higher, okay, so I'm still contending that my calculations are going to hold true, that the market can't really get through this level with any kind of zealousness, if you will, other than for a short-term spike and then a reversal, okay? Now, I'm not suggesting I'm right all the time. I'm just saying I'm not ready to throw in the towel and say I'm wrong. It just hasn't happened yet, okay, in my mind. This week is still scheduled for a cycle weekly top in the stock market. Now, what does that mean? That means it could still be plus or minus 1 week. Minus is out. That was last week. Okay? So it's this week or next week. So this could be prolonged a little bit longer, and we can still see the pullback. And remember, it's only a pullback. I'm not looking for anything major here. Okay, the first level is going to be around your 50-period moving average if we did sell off. Okay, and your next level to watch out for is going to be all this, now what becomes support in this area where we bounced off these levels 4 times. Now, we may or may not hold. The 200-period moving average is upsloping, and I'm not expecting a dramatic sell-off, so I don't even know that we would ever get down there on this move to begin with. But what I am looking for is a couple of weeks at maximum, really, of downward pressure in the market where rallies could be sold, and we wait for some kind of a bottoming signal that we can buy for the next multi-week or maybe even month or two rally. That's all we're looking for. It just hasn't happened yet. We're in stall mode, and that's really all we have. So we have to wait for the market to tell us what to do. There's nothing other than that we have control over. We have to wait for the market to tell us, here's the next move, okay? And that's the position we're in right now. So there is one, I always like to look at market signals, all right? I look at the IWM all day, every day, okay? And when there's something material to show you, I bring it up here. I don't see anything in the IWM today material, so I'm not bringing it up. But, okay, what I do see that was interesting was the transportation index. Now, what's the transportation index? The transportation index is everything that moves stuff around. All right, your rails, your airlines, your trucking companies, your UPSs, your FedExes, and the list goes on and on and on. So this is really the heartbeat of America in terms of stuff moving around, and I'm not saying we're seeing any kind of long-term shift or anything like that. That's not what this conversation's about. What this conversation's about is, what did the transports do today? The transports can be a leading indicator of the market. And what's interesting, and I noted, shame on me, I hadn't noticed this really up until today when I saw this, what could be a topping tail, on the daily chart. Now, the volume wasn't great, wasn't bad, but it wasn't great. The volume today was almost 13 million shares. It's probably a little above average, but it's not great. But guess what? High, lower high, and maybe another lower closing high. That's possible. That would be bearish. So it's just something to keep an eye on, and it's something I noticed. So I'm going to keep it on my watch list, in the forefront of my mind for the next several days, and we'll see what happens to the transports, and we'll see if they do end up being a leading indicator of the market. All right, let's move on to crude oil. So here's what happened. I'll bring the chart up of the USO, but I'm going to talk about the numbers on the crude oil contract, Now, since last Friday, I was telling you that on an hourly basis or daily close below $52 in the price of the March crude contract. Now, we've rolled over to April at this point, but this began with the March contract, If a close below $52 hourly and then daily occurred, we should see a quick move down below 50 to about 49, 75, 85, and that would basically complete the numbers that I had available to me based on my calculations, right? So on Tuesday, it faked us out. It almost happened. It broke below 52. It went down to, I don't remember. It went down quite a bit, and then it reversed and it went higher. And then yesterday, what did crude do yesterday? I don't think it was anything spectacular yesterday. And then this morning, it really got wrecked. And what happened was it broke below 52, and it went all the way down to like 49.15, I believe, was the low. And then it reversed higher. So what happens is, and how you make $2,000 a contract in the price of crude oil is, on a trade like that, when it starts to close hourly below 52, you put the trade on. You're short crude contract at 52, for example, if you can play futures, if you do play futures. But either way, it's a good lesson. So you're short at 52 or below. Your stop is above an hourly close above 52. And then what happens is, as it begins to go lower, let's say you had 4 contracts, for example, as it begins to go lower and it's lower by $1.50, you take 2 contracts off, and you put a stop in, a trailing stop, either you begin at either break even, where you began the trade, or you begin above where the price is with a trailing stop, and you just let it fall. And as the price falls, the trailing stop, maybe it's 25 cents, maybe it's 35 or 45 cents. Where you put the trailing stop is a lesson for another day. But you put the trailing stop in, and as the price goes down, the trailing stop comes down with it. And if the price begins to bounce up, and it takes you out of the market, it's the best trade on the books because A, you already have a profit, you're guaranteed a profitable trade, You can have a big downside. Some of the most successful trades happen with a trailing stop on the up or the downside, the runaways. Sometimes stocks or commodities or whatever you're trading just run away. And so the trailing stop takes you out unemotionally, and that's the key, right? It just takes you out of the market. Wherever it takes you out of the market, you know you have a profitable trade. It's just a matter of how much. On this trade, now if I was in, at 50, a close below 52, I was in, slightly below 52, I had my trailing stop. I got stopped out at about $49.60, okay, when it was all said and done. But here's the key, okay? How you make $2,000 a contract is each penny in the price of crude oil, okay, that ticks away is worth $10. So every dollar is worth $1,000. So $2 in the price of crude oil on the downside or the upside per contract is worth $2,000. That's how you make $2,000 per contract inside of a day in the price of crude oil. Pretty slick stuff. Doesn't happen every time, can't happen every day, but the trade setup was there, was looking at it for a few days, was talking about it for a few days. It played out perfectly, and those that took the trade, congratulations, awesome trade. It was quick and clean, awesome trade. All right, let's go over to gold real quick, and then we'll give her a wrap here shortly. I know it's getting long in the tooth, this video. So on gold, let's bring up the GLD. Gold, started the day, actually it started the evening or overnight higher by $20 from yesterday's COMEX close, okay? And so what happened was it sold off in the morning. Let's bring up the intraday chart, okay? And you can see what happened. Okay, gold spiked up, and then it just kind of melted away throughout the day. But if you look at the longer term picture, okay, and those that get the trade alerts understand more of what I'm talking about. I was talking about this level down here, a break of 116, which would be, my initial target was 12.12 in the price of gold futures, and we're kind of hovering around that neighborhood now. We're at 1208.50 as I make this video, but we've hovered around 1212, 1210 for a while. We got down below 1200, but I said, in that neighborhood, 1212 was going to be a good target for a buy area. That coincided with around this area here, just around 116. And we broke below there yesterday, but we bounced up, and it looks to be some kind of a bottoming tail. We can make a case for that. So we have to watch this for a few days and make sure it plays out. Any close below this low here would be negative news for gold. So that's what we're keeping our eye on right now. There's really not much else to talk about for gold. We're kind of in the trade, and there should be some upside going for us in our favor. The bonds, real quick, we'll look at the TLT because bonds spiked yesterday after the Fed announcement, and then they were down a little bit today. But, let's look at the intraday. They were down a little bit today, but nothing dramatic. If we look at the daily chart, okay, of the TLT, all right, which represents the 20 and 30 year long bond, okay, opposite the yield, now it's really up to the market to stay above this low here, which would be 125.92. 125.92 is your line in the sand. If you close below that level, there's more downside. And then what happens? I believe that we go to the second target, okay, which was 124.25. Okay, so if we close below that low, then we go to 124.25. Close below the daily low from the yesterday, or was it the other day? Let's go back and look. I already forgot. Yeah, it was 2 days ago. Close below this low, okay, 125.92, and I think we go down to 124.25, and I think that's a buy-in with both hands. Because why? Because we have a weekly cycle bottom due this week, plus or minus. Minus is out, plus 1 week. So what that means to us is we should be seeing higher prices in the bond market, lower yields, and I've been talking about that, and I said the lower yields would normally and generally coincide with lower prices in the stock market, so we'll have to see how it plays out. We're in a holding pattern right now. We have to wait for the market to tell us what to do. All right, I know it's long in the tooth. I'm going to give it a wrap there. Hopefully it's helpful. I'm David Frost, mystrategicforecast.com. Thanks for tuning in for another episode of Common Sense Market Analysis.